Hello, my name is John Peterson, Vice President of Stewardship and Education at the Florida United Methodist Foundation. Your presenter for this segment is Pam Hicks. Pam is the Foundation's Vice President of Finance and Administration. She's going to be talking about the very important topic of taxes and tax planning considerations for retirees. Pam will cover a variety of tax subjects such as how to maximize your income and how to keep your taxes low. She's going to talk a little bit about how to do your housing exclusion, estimated tax payments versus withholding, and how large withdrawals will affect your tax liability. After watching this segment, I would ask that you would write down any questions that you may have and submit them to Nadera Bledsoe at nbledsoe, B-L-E-D-S-O-E, at fumf.org. Nadera is going to be compiling all of the questions that you submit, and those questions will be answered during our Q&A session in January. The Presente and Futuro Zoom session is going to be held on January the 9th, followed by the R-10, the English session, will be on January the 25th. I hope that you find this segment very helpful and the information very relevant.
Hi, I'm Pam Hicks from the Florida United Methodist Foundation. I'm the Vice President of Finance and Administration, and I'm here today to talk to you about taxes, specifically taxes in retirement for ministers. Let me start off by saying this to you. Thank you. Thank you for your many years of service. We appreciate all that you have done for the church over the years of your service. I want to also say this would be a discussion, not a talk, if we could be face to face. And I really do miss your faces and your questions. I'll try to interject some questions as we go along and answer those. But feel free to contact me at any time at phicks@fumf.org. That's phicks, P-H-I-C-K-S, at fumf.org. Or you can call me at 863-904-2970, extension 7110 is my desk. But during this time of the virus, you can reach me at 7210, which is my cell phone, or 7310, which is my home phone. Please call at any time. I might not know the answer to your question, but I can help direct you to someone who does. Let me go on with a little bit about the mindset for me in preparing for this. I'm like you on that train. Let's use a few similes and metaphors. The journey of life. I'm on the edge of being retired also. So as I thought through what I wanted to discuss, I tried to look at the things that were pertinent to me, but I'm not a Methodist minister, so I tried to add that caveat of a Methodist minister or a minister in retirement, but also look at the spouses if the minister is married. So I tried to interject some personal themes into this as we go along. Let me tell you a little bit about myself. I've been at the foundation for 20 years. I was the treasurer originally, and then I became the vice president of finance and administration around 2015-16. My background is I have a degree in math and a minor in chemistry. I taught science and math for 6 years in high school in Polk County. The last year of my college, which was Florida Southern, the last 2 years, I took accounting and I loved it. So while I was teaching high school, I went back to school at night and picked up the accounting classes. I then sat for the CPA exam, passed. I had a child, and so I didn't start to work till after I had passed the CPA exam. I then went to work at a CPA firm locally, and I stayed there for about 11 years before I went to another small CPA firm, one in Lakeland, one in Plant City. And during that time, I always did income tax returns, and I worked on the audits of not-for-profits, governments, and banks. In 1994, I went to work at the Community Mental Health Center, Peace River. It covers West Polk County, and I was there for 6 years. In 2000, in 2000, I came to work at the Florida United Methodist Foundation, and I've been here since for 20 years. It's been a great fit for me and a great job. Believe it or not, it's the first time I prayed about a job, and I didn't get it initially. It went to someone else. They lasted one day, and then I got the job after that. So it's a true story. I'm here on a prayer, so to speak. So that's enough about myself, but feel free to contact me if you have any questions. Now, a disclosure. I am not giving you tax advice. Do not take any of what I say as advice to the bank. You need to seek professional help. So let me just say the things I want to consider in my talk today. And there's 5 things I really want to consider as far as taxes. How do we maximize the income, really the cash flow, and keep your taxes low? You want to try to take any income that's deferred, in my opinion, and move it to you want to move it out of deferred into already taxed if you can. So you want to maximize that cash flow if all possible. For ministers, you have the housing allowance, which is special, which is under Internal Revenue Code, I'll call it IRC, Section 107, that affects retired clergy a little different than the way it did when you were serving a church. Also, how are you going to cover your taxes? You had this when you're working, estimated tax payments versus withholding or a combination. And also, this is another one. How large withdrawals affect your tax liability? Should you pay off your home or debts, or should you not do that and pay payments over the life of the debt? The last item is we're going to discuss it now, and it'll be over moving expenses. Moving expenses are no longer allowed as a deduction for anyone's unless they're in the military. So ministers no longer are allowed to exclude moving expenses or get a deduction for moving expenses. So those are the items I want to cover for taxes. These are the items I want to cover. The first one, maximizing income and keeping your taxes low. The very first one is really one I want to address for everything we discussed today. You need to find a tax advisor. You need to find a tax advisor who knows how to do ministers' tax returns. I cannot tell you how many tax returns I followed where the tax advisor, the tax preparer, whether they're a CPA, whether they're an enrolled agent, they did not know the specifics of ministers. They prepared the returns incorrectly. So that's the first thing you want to do. I do not think the minister's tax returns, even in retirement, lend themselves to being prepared without professional help. You're also going to need a financial professional to help you determine how to navigate this whole thing, as far as a certified financial planner or someone you can rely on. You can't just go one and done. The laws and circumstances are going to change. Your circumstances are going to change many times during retirement. A lot of that relates to emotional change, but it could also affect your financial picture and your taxes. Don't just feel like you go to the tax advisor once a year. You may need to meet with the tax advisor prior to making a major change so you can get information related to that change and make the right choices. And we're going to see an example of that as we go on. The next thing you need to do, and you need to be prepared, you need to know your sources of income, and I'm calling income cash flow. It could be construed as taxable income, and it could be not taxable, but know your cash flow in retirement. Know your needs. Do a budget. You may have to do a budget every year over the next few years. Look at what age you're going to start Social Security, because that is very, very important. It not only grows the longer you wait, but there are disadvantages if you take it early and you continue to work, you have to pay it back. So know these items about yourself as you do your planning. So basically, it's some planning has to be done, and it probably needs to be done every year. Know your deductions. Review your exemptions. The exemptions actually have gone out the door. And know your itemized deductions under tax law. For most of us, the itemized deductions have gone away. We no longer can take itemized deductions because the standard deduction included exemptions now, and it's so high, most of us are not allowed to use itemized deductions. But you do need to look at that. Social Security is the next item. Most of us think, oh, Social Security, not taxable, but that's not true. And I don't know if you realize this, but up until the year I started working in public accounting was 1983. At that time, Social Security was not taxable. But with the 83 Act, the Social Security became taxable in 1984. This amendment made Social Security taxable at 50% in 84. In 1993, the Omnibus Budget and Reconciliation Act made some tax associated to Social Security at 85% for the higher earnings. So we're going to go over how Social Security could be taxable and also look at a calculator. Some income or deductions may have limitations or requirements, so that's where you really do need to seek that professional help. You may not be able to drill down to what the answer is in that area. One of the things I wanted to talk about as far as income was some information and resources on WestPath. If you could go to www.westpath.org, if you have access to a computer or some device that would allow you to do it, a tablet or even a phone. On westpath.org, under Retirement and Investments, if you click on that, over to the right are retirement plans. You can look at the various retirement plans that ministers have access to. I know John went over these retirement plans, the CRISP, the MPP, and the pre-82. Pre-82 were for ministers prior to 82. From 82 to 2006, they were under the MPP, which was a combination of a defined benefit and a defined contribution. So you'll have a set amount coming through that you'll know, and then there may be a lump sum distribution. And then from 2007 on, you're under a CRISP plan. Sometimes the funds would flow into the CRISP plan out of that MPP plan. So you're going to need to get with WestPath and know what your sources of income are, what they will be, and what you can do with them. So I recommend everyone use this tool on their website. Also, if you go under your specific account, across the toolbar is a Learn. And if you would look at Learn and drill down into Learn, all of this information that I just discussed on the general website is also on that Learn button in a different format. I would recommend you read both sections because it's very, very good information for ministers and for ministers who are about to retire. It explains some of these acronyms and some of the types of income that you may be eligible for in greater detail. All right, now I want to give you an example of meet with a tax advisor. I know a lot of Methodist ministers who have been given a parsonage over their life as a minister, but they took funds and set them aside and bought a second home, so that when they retired, they would have a home that they own. Now, recently, the church has been giving monies, housing allowance dollars versus furnishing a parsonage, and many ministers have bought homes and had the home, and if they were moved to a different appointment, they would sell the home. So basically, a home could be an issue that you needed to sell while you might have had it purchased it while you were under a appointment. It may have been a vacation home for you and you had a parsonage. Well, we are allowed to deduct up to 250,000 if we're an individual and 500,000 if married filing jointly on the gain or sale exchange of a personal residence. But there are special rules with it, and being a minister, you may or may not have lived in that home. You must have owned the home as a principal resident for at least 2 of the 5 years, which is 730 days, ending on the sale exchange date. Does not have to be continuous, so you don't have to have lived in the home day 1 and ended it in 5 years. You can split that up just so that you have the 730 days, the 2 years. The second requirement is if you don't meet this requirement of 2 out of 5 years, you will be able to prorate it, a fraction of the 250,000 and the 500,000, equal to the percentage of ownership and use requirement met. So there's specific rules related to that allocation. Exclusion may not be claimed for more than one sale or exchange during any 2-year period. So you can't just start recycling homes and you think you're going to buy a larger one and then just keep getting your 250,000 or $500. So this is definitely one of those items where you need to meet with an advisor. You need to see if you're going to meet that 2 out of 5 year item. You need to know what your fair market value of your home is to see if you're going to be under that $500,000. This is the gain on the home. So if you paid $200,000 for the home and now it's selling for $700,000, you're going to get to exclude that $500,000 gain. It's not the home sells for $500,000. So this is definitely an example of where you would want to meet with an advisor or a financial planner to determine what you needed to do there. Now the second one, before I go to it, example, it really is a question that someone may bring up, because if you have been living in a parsonage or you still have a home because you've had to buy 2 homes because you were transferred and you still have the old home and you haven't sold it, is what happens if you rented one of these homes. And the next slide kind of goes over renting the home. And this is again where you need to meet with an advisor, because the tax laws can change. I can tell you they've changed since I've been in public accounting. It used to be the limits were much lower, and what you did is you deferred it and you rolled it into the cost of the new home. But it's not that way anymore. You get that 250 and 500 right off the bat. So definitely this is where the tax laws could change, and you may not know it. Here we're talking about it today. 5 years from now, when you're ready to sell the home, it may be it's changed where you have to pick up the 500,000, or now it's 700,000. So you need to meet with an advisor with some kind of question like this. There's a whole publication you can find on the IRS website, www.irs.gov. It's on the slide, the rest of the location. You can even search for publication 523. So let's talk about this. You've rented it. So the space was once used for business or rental purposes, either one. The space was not, to exclude it, the space should not be used for business or rental when sold. So when you sell it, you should not have renters in the home. You should have no business or rental income from the space in the year the property was sold. So for that year, you should not have any income showing. The space still has to be used for personal residence 2 out of the 5 years leading up to the sale. If the space considered residence was sold, former business usage does not affect the gain or loss. But say you don't meet these criteria. There again, just like with the personal residence where you didn't meet the 2 of 5 years, there may be some prorations or fractions of the 250 and 500,000 that you will be able to exclude from income. So a portion may still be excluded if you used it for business purposes. So this is a question that could come up for you. Seek the tax advisor or the financial planner in that area. All right, sources of income I wanted to discuss. Some of you may decide to take your Social Security. You can take it at age 62. Others may want to wait to full retirement age. So you need to look at your complete picture to see if you're going to have enough cash flow to meet your budget, your expenses. You also need to look, are you going to continue to work after 62? And if you're going to continue to work full time after 62, for most of us, it does not make sense to take Social Security until you retire because there are limitations on what you can earn. If you start early, it decreases the benefit that you're going to receive, and it's a percentage of each month before full retirement. There's on the website to determine the benefit of retiring early. You have to select your birth year to do this. It's kind of a benefit for anyone that was born January 1st. We have an employee who was born on New Year's Eve, Darlene Kepner. I don't know if any of you have talked to her, but she will be allowed to use the year before as her birth year instead of the year she was born because she was born on January 1st. It's just a little idiosyncrasy. This is a table, and it's probably been gone over during the Social Security time. But for me, I was born in 1955, so I will have to be 66 and 2 months to get the full retirement. And this shows you what it would be if I took the retirement early, and also for my spouse if they took the retirement early. Now let's talk about growth. You can defer taking Social Security to after you turn 66 and 2 months, in my case. And in that case, it grows at 8% per year. So, and it's compounded. You have to take the Social Security at age 70, but it can grow at 8%. So there again is an opportunity for you to meet with an advisor to see if it's better to take the Social Security at full retirement age, save that money, maybe you're still working, or would it be better to defer over the life? The thing we don't, any of us know, is when we will pass away. We do not know our date of death. So that is one of the items that makes sometimes estimating and projecting difficult. But for the most part, you need to go forward and make your decision the best you can on when to draw Social Security. If you retire early, you're going to have to return $2 to $1 over the amount that's allowed. It's a little over $18,000 in 2020. All right, the next slide talks about Medicare costs because this is one of the things you're going to have to budget and is deducted also from your Social Security. The standard premium on Part B now is $144.60. It could be less for some people. Some people could get an HMO that actually pays them back this amount. If you're going to pay the standard premium amount or higher if you enroll in Part B for the first time in 2020. Even if you don't get Social Security benefits, you're going to have to pay it if you enroll. You're not required to enroll. You're allowed to enroll when you're 65, but you're not required to enroll. You automatically receive Part A by enrolling, which covers hospitals, and for most people it does not cost anything. B will be directly billed to you if you elect to continue to work, because for me, I won't be at my maximum retirement age. So this year I am going to sign up for Part B and Part A of Medicare, and will have to pay the amounts. If you're still working, that last item, you may have to pay more than the $144.60 sense because it looks back at 2 years to see what your income was in that 2 year period prior. So for 2020, it's 2018. And there's a table which I've listed on the Medicare.gov website on the slide that shows you what you will have to pay based on what your income was 2 years ago. So I just wanted to cover that if you're trying to budget for your Medicare cost. Sometimes you may have something unexpected happen, an income item you didn't realize you were going to have, and so you may owe Medicare for back years when you don't know it till you do your tax return. So you may have a cost that's taken out of Social Security in later years for a prior year for Medicare. My father's friend, who was a gambler, had a huge gamble winning that he had to go back and then pay for his Medicare cost at a higher rate because he had to claim the gambling winnings in that year. But you could even sell stock. There's many items that could come up as income that you would have to recalculate your Medicare payments, and they probably will not be done until the next year because you didn't know the income was going to be there. All right, the next area I wanted to go over is itemized deductions and personal exemptions. Well, the Tax Cuts and Job Act of 2017 repealed personal exemptions, so no longer can you get a personal exemption on your tax return. What they did is they increased the standard deductions, and I've listed a place where you can look at the guidestone where they have a summary of what was changed. They did allow for additional standard deductions for people who are blind and over 65, so that was increased. Here is a table from 2019 of the standard deductions. And 2019, married filing jointly was $24,400, and the additional for over 65 was $1,600. For 2020, that amount is $24,800, so it increased for $400 for married filing jointly. Head of household filers is $18,650 for 2020 versus $18,350 for 2019. Married filing separately and single are now $12,400 versus the $12,200. In 2020, $1,650, it went up $50 for the over 65 for 2020. Now, what happens with this high standard deduction is most of us do not have enough deductions to itemize. So most tax returns are going to end up with just the standard deduction and not the itemized deduction. Next are the tax rates. These tax rates are for 2020 and they expire in 2025. The rates are also usually adjusted every year for inflation, so they change from last year to this year. These are the 2020 rates, so let's read how they work. For a single person up to $9,875, the tax rate would be 10%. Over that, up to $40,125, the tax rate would be 12%, and so on and so forth. So the rate is graduated, so you have to calculate your income in each of these rates to figure out what your total tax liability will be. So the rates from 2020 to 2025 are 10%, 12%, 22%, 24%, 32%, and maximums of 35 and 37. These graduations are going to change. There again, why you would want to consult a professional or at least research what the change in the graduations would be. The next slide talks a little bit about itemized deductions and some that may be of concern. Has been a concern for churches and not for profits. Would people give since they may no longer itemized? Charitable contributions available are still allowed, but they were altered. The increased standard deduction may exceed itemized deductions. So you may no longer get to take your charitable contribution as an itemized deduction. But for most people, the reason to give is not based on these itemized deductions. And still, there is the ability for those who have high income in a year to use donor advised funds to make a larger deduction, which would increase their itemized deductions, reduce their income for the year, and be above the standard deduction. I'd also increase the annual limitation percentage of adjusted gross income to 60%, which is a benefit. It used to be 50%. And it still allows for itemized deductions for planned gifts, the donor advised funds, the IRA rollovers, the sale of appreciated stock. These did not go away. So if you're thinking about giving funds and you have an IRA, you can roll over from the IRA to the charity and not have to pay any tax. You probably will not have a deduction, but you will not have to pay any tax on the money that you take out of your IRA. You cannot roll over from the WestPath pension plan. You would have to roll the money out of the WestPath into an IRA, and then from the IRA into to the charity to be able to get that tax-free treatment. This is another thing that kind of hits ministers. You're no longer allowed to have the miscellaneous deduction subject to the 2% AGI. Many ministers use that to deduct business expenses. This is no longer allowed. So the miscellaneous deductions went away. It doesn't only include business expenses, but it's gone from the itemized deduction. Home mortgage interest is only for modified separating acquisition indebtedness from home equity indebtedness. So if you went out and said, "Oh, I'm going to borrow on my home. My debt is $100,000, but my home is worth $250. I want to borrow $50,000 to send my child to college." That is not acquisition indebtedness. So there is a limitation. You have to prorate it what you can deduct. Now, if you borrowed $50,000 to improve your home, a roof, an additional bedroom, additional room, that is considered acquisition indebtedness, and you would be allowed to deduct the full amount. Pay attention to this because this also affects your housing exclusion and what you can exclude. It follows these same rules. When I started in public accounting, there were no rules separating home acquisition debt versus home equity debt, and you were allowed to deduct the full amount. So the law has changed, and another reason why you need to be on top of what's going to happen. Now, casualty and theft deductions, except under presidential emergency declaration, was repealed. So now you can have casualty and theft deductions. Also reinstated the 7.5% AGI for medical expenses for 2017 and 2018. It had been 10%. So that was lowered for those who have excessive medical expenses. Here are some other considerations. They may or may not apply to you that came out of the law. Consolidations and repeals several education related deductions and credits. They modified alternative minimum tax. It's called the AMT tax, so it applies to fewer taxpayers. And they modified the generation and estate skipping transfer taxes. All right, taxable Social Security. I think this is a really important area to know something about, and actually you can do some calculations with this yourself. Social Security could be taxable It might not be, but it could be. And so there is a sheet that you have to use to determine, if you're preparing your tax return by hand, if your Social Security is taxable. It could be up to 50% taxable, or all the way up to 85%, or it could skirt on the line and be part is taxable at 50% and part at 85%. So you have to be able to do the calculation on that. And there's a publication 915 on the IRS website that would help you with this calculation if you needed help, just to read through and see how to do it. There's also a worksheet. The quick computation is to figure your income. You have to look at exempt interest and exclusions from income, and you have to add that back. So it's not just your taxable income, but it could be income that you are not required to pay taxes on. You take that income and you add half your Social Security benefits. Then you compare it to your marital status, the base amount. If you're married filing jointly, the base was 32, it's up to 34 now. For single, it's 25, head of household and qualifying widowers with dependent child. It's 0 for married filing separately, so that'd be one reason why you wouldn't want to do married filing separately. So you're going to make your Social Security taxable. If the total is more than that base, some benefits may be taxable. So you could start out, here's an example. John and Jane Mapies have AGI of $24,000 for 2019. John, who is retired, receives Social Security of $7,200 per year. The couple also receives $6,000 a year from a mutual fund that is invested in tax-exempt municipal bonds. On their 2019 joint return, the couple would make the following computation. Remember, for joint, it was 32 we were using as the base. So you have to take the 24, the AGI from the tax return before you add Social Security. You have to add the tax-exempt interest, which would make it 24 plus 6,000 is 30,000. Then you would add half of the Social Security, which is 7,200 divided by 2 equals 3,600. And the provisional income would be 33,600. You subtract the base amount, and 1,600 is the excess above the base amount. So half of that would be $800. So it's the amount over that base is going to be taxed at 50%. You compare that to half the Social Security, 3,600, which is the lesser of. It's going to be the amount over that base. So you're going to have to include $800 into your income from Social Security. So the amounts are laid out, the 25 to 34. When you get over 34 for 6 single individuals, you're going to have to pay 85% of the benefits taxable. So when you start with an AGI plus the exempt or excluded income, if it's over 34 to begin with, then all of your Social Security is going to be 85. If it's less than that 34 but over 25, you're going to have a prorated amount. The difference before reaching 34 is going to be at 50%, and the amount over 34 will be at 85. It's the same for married, except the range is 32,000 to 44,000, and anything greater than 44,000 is at 85% taxable. Married filing separately, up to 85% taxable regardless of income. So you don't get an exclusion if you decide to file married filing separately. There again, that's where you would want to consult an advisor to see if there's some reason why you should be filing separately. And up to determining taxable benefits is not a simple multiplication. There's a Social Security tax calculator on the IRS website, and there's also a worksheet on page 7 and 8 of the publication 915. I'd like to show you now the website. If you go to irs.gov or www.irs.gov and you go into the search bar and you type in ITA Social Security, you will come to the drill down to the calculator. Under that search, as you bring the bar down and search for the interactive tax assistant, helps answer many tax questions. That's what the ITA stands for. If you click on that calculator, it gives you many calculations you can use this for, not just for the Social Security. It's sometimes hard to find, but it's right here under Interactive Tax Assistant. It's underlined. And as you come down, you can either use the search bar to find it or the bar at the right to find Social Security. It takes 9 minutes to do the Social Security calculation. It's under retirement, pensions, IRAs, and Social Securities. You have to know your income, your AGI, like we just discussed, and any income that is excluded. You have to answer questions about how you're going to file, and you also need to be able to answer questions of whether you're working or have income outside the country. So let's just do it. It's down here at the bottom. It takes 9 minutes. Let's use the example that I have in worksheet format, where that income is now $53,600. That's the provisional income. The income is higher. The Social Security was still $7,200. So if I just subtracted that $7,200 from the $53,600, I would get $46,400. So the income was $46,400 before, I guess it was $50,000 if I added 50%. It was $50,000 before I added the 50% of the $7,200, which is $3,600. So let's just walk through this. Then you'll be able to go back and do it. We'll use this example. You'll be able to do it every year with your numbers and your amounts just to see how much is taxable for that, how much you think you're going to have to pay tax for that year on Social Security, because it's usually something we don't think about as being taxable because we feel like we've already paid tax on it to begin. It was a tax to begin with. So you begin the process and it says, are my Social Security or railroad tax tier benefits taxable? And you hit continue. And we're going to do what year we're going to select. It's going to be 2019. They don't have it out here for 2020. We will continue. We'll select our marital status. This couple is married. We'll continue. And did you file a joint return, or you intend to in 2019? You answer yes. And then, did you or your spouse receive Social Security? You'd answer yes. Are any of the spouse received as disability? You would answer no, because as far as we know, none were disability payments. And then you enter the dollar amount you received. So we know that $7,200 was received. So we type in $7,200 and we continue. And did you or your spouse contribute to a traditional IRA for 2019? That affects it, so no, there was no IRA contribution. Did you receive lump sum payment for a prior year? No, from Social Security. And What is the amount of your taxable pensions? It was 50,000. First, I was subtracting the full 7,200, but I should have did half of it. Did you have any tax exempt interest? No, that was already included in that 50,000. Savings and bonds, which are tax exempt to a certain extent? No. And what was your employment status? We say neither because you're retired. One of you may still be working. If so, that it would. And then what's your spouse's employment status? Neither. And so outside income from the country? No. And did the spouse have outside income? No. And then what are any other adjustments for student loans? Zero here. And you just continue through, and at the end, did you have any Social Security? Did you have any withholding withheld? No. And from Social Security, it comes up with a printer-friendly document, and it's telling you that 7,200 of your Social Security line would be $6,120. It wouldn't be the full 7,200. And the worksheet did the same, came up with the same amount. But this calculator would help you in any year determine what amount of your Social Security is going to be taxable. So it would help assist you to know ahead of time before you went to the advisor. There are other calculators on the web. If you just type in Social Security benefits taxable, you may use a different calculator than the IRS. The nice thing about this interactive tax assistant calculator is it does it for different areas, even itemized deductions, if you were to look at those. So use this tool and try and see what you come up with for your own benefit in future years. This is the worksheet that came up for the same amount. Okay, let's talk about ministers. This is really what makes ministers unique, is the housing exclusion, and the housing exclusion even into retirement. Ministers are eligible for a housing exclusion. A portion of their pension income is designated housing allowance. Normally that's by the church, but in our case it's set by the denomination's pension fund board. And basically it just says the lower of whatever you spend is what you can take for your housing allowance as a retired minister. If the clergy person has no relationship with a local church and relies on a fund for pension compensates the clergy for past services to local churches or denomination. They may also be allowed to have a housing exclusion. In most cases, you'll be eligible to have some or all of the benefits designated in advance. This is where I think there's a really good worksheet on the conference's website, flumc.org. If you go to that website and you just use, I've got the exact location, but if you just use the search bar and you type in housing allowance, it'll bring up several different items for you to look at. Not finding the search bar. There it is. It's kind of on the far left. So type in housing exclusion, and our own conference has materials out there. You'll see Florida Southern Housing first, but go to the parsonage and housing allowance. I have the direct website if you want to type it in. It's really, the worksheet is under housing allowance question and answers. And this is a really good source. It's also on the General Council of Finance and Administration's website. At the end of this source, this PDF file, are worksheets which assist you in laying out your cost for your housing exclusion, and they are excellent. So use this not only to read the housing allowance, what's allowed, but also to use it to do your calculations annually. The housing allowance resolution stating Westpath pension payments qualifies in housing allowance is handled annually at conference and is part of the journal. So you don't have to worry about that. They bring it up when you retire, they approve it, and it's really the exclusion rules. It's the lesser of the amount designated. In this case, they let you designate the actual housing expenses or the fair rental value of the property, the lesser of. So it gives you a lot more leeway than setting a dollar amount, because it's for all retired clergy and not specific like it is in churches, where you set the dollar amount, the minister gives you what they think they're going to spend, and you set that as a housing allowance at the charge conference. So this is done at the conference annually. It's a little bit freer, and it really will assist you. I want to go through an example. So you receive your pension. You receive a 1099-R for pension, which lists $15,000 in box 1. And when we look at your housing allowance, we filled out all the information. You actually had $13,000 in actual expense and $14,400 fair rental value. So we see the $15,000. The housing allowance was $15,000. That because it's the maximum of what you get from the pension. The actual expenses is $13,000, and the fair rental is $14,400. It's the lesser of those three numbers. So the lesser of those three numbers is $13,000. So the tax-free portion is $13,000 that you will show on your tax return. The taxable portion of the allowance will be $2,000. So I wanted to kind of show you with this next slide how you would place these numbers on the tax return. So the $15,000 is going to go in the box for retirement from pensions. That's the A part. It's 4A, so we would list the $15,000 there. You list the full amount you receive. Over to the right, under 4B, you list the amount that is taxable. So we excluded $13,000. $2,000 will be taxable for this year. So $2,000 is I said that backwards. $2,000 is what you will pick up as income. $13,000 will be excluded. So the tax return has $15,000 and $2,000. It does not show the 13 on this page, but it's recommended that you create a schedule and attach it to the tax return as an attachment showing what your exclusion allowance maximum was, what the fair rental was, and then what you paid for each of these expenses that are allowed. The other thing that is always needed is that these payments at the bottom, you see it, payments are deemed pursuant to IRC section 107. A minister of the gospel may exclude amounts deemed to be rental allowance. So that is placed at the bottom of that page and usually attached by most of the preparers. I obtained this form from our tax accountant, and this is the form that they attach to all of the retired ministers' tax returns. So let's go through this. Housing exclusion in a retired clergy. You may exclude the rental value of a home plus utilities furnished by part of the church as part of pay for past services from gross income. The second one's very important. If you're the surviving spouse of a minister, you are not allowed to exclude any monies from the pension account. So if you're still receiving the $15,000 because that's what was elected, and you're the surviving spouse, man or woman, your spouse has passed away, you're going to have to pick up the full $15,000 in that example I just looked at. You will not get an exclusion. There again, that's why you have to be prepared to know what your taxes are going to be and also to budget for that. The next one is kind of a moot point right now, but it was brought up in won an appeal in Wisconsin to not allow ministers to exclude housing allowance from taxes. But this was lost its appeal in the 7th District Court. So right now, ministers still are allowed to use the housing exclusion. It is every few years there's rumblings around the country from various groups that bring up cases to not allow ministers to exclude the housing for income tax. All right, let's go back to that and let's just ask a few questions that I came up with. And John and I actually had a person come up after one of our presentations and ask this question because this is what she did. She had paid off the house. They went into retirement with the house paid off. Well, the problem was that was one of their largest expense that they were going to be allowed to exclude. By paying it off, they no longer got an exclusion of their pension because they paid the principal and the interest payments were no longer there. So if the payments were $3,000 a month, I'm just making a large number here, I know, but even if it was $1,000 a month, they lost $12,000 to be excluded from their income by paying it off early. There again, I can't say whether that was the right or wrong thing to do because I don't know all of the ins and outs. That's where a professional would be able to sit down and talk to you one-on-one and know. But looking at it from a tax perspective and an exclusion perspective, I would say you shouldn't have paid off the house. But I don't know all the ins and outs. But you need to realize that if you pay it off, you're not going to have the largest expense allowed, and so more of your retirement is going to be taxable. So that's one thing to consider, and that's why some people decide not to own a home, but they rent a home. So they still have that payment, the fair rental value to deduct. We went over the surviving spouse, so please do not forget that one. What about a down payment? This occurs even if you're not required. In the year of a down payment on a home, that is the year you pick up that deduction. So if you put $10,000 down, say you're going into retirement and you've never owned a home, you put $10,000 down, you want to do that, it will be included in that year you put down the $10,000 as part of the housing exclusion calculation. It'll be part of your actual payments. What about people who elect to go into retirement homes? You know, that's probably one of the most difficult decisions for people to make and an emotional decision. But there are some benefits to that. The down payment from retirement homes is allowed as an actual expense. It cannot be amortized. It lost a court case on that. And as you make your maintenance fees, if the maintenance fees include food and services, you have to prorate it. But the maintenance fees for that retirement home are allowed. So that, along with any down payment, subtract the food you received, subtract any services you received, will be allowed as actual expenses to offset your retirement benefits. All right, let's go to this because we kind of talked about this on the itemized deductions, but when you have a home and you decide to use it to borrow for other things than improvements, that money you borrow for other improvements is not going to be allowed as a deduction for itemized deductions, and it's also not going to be allowed as an actual housing exclusion deduction. You would have to prorate your payments if it was all in one from acquisition indebtedness or actual physical improvements to your home, and also from the just home equity debt, because it's not going to be allowed. So say you paid it off and you thought, oh, I have a bright idea. I'll do a reverse mortgage and get all that money out. It's not going to work. So there again, you wouldn't want to go off and do that without consulting a tax advisor or a financial planner. So these are just some questions that have come up over the years and some items I thought might be of interest. If you have some other questions, please just let us know. Now I want to go back to the website, this time back to WestPath again. WestPath, on that website, other than just retirement plans, if you look under retirements and investment, has tax information. And under the tax information, if you pull the bar down, you will see a whole section. It comes to it immediately on housing allowance for clergy. And they have at the very bottom an underlined clergy housing allowance. If you click on that, at the very end of this, it goes into detail, is a whole section on retirement. One of the things I'd like to bring up about retirement is, and they have it at the bottom, this pension has to come from your denomination. And so if you decide to take some of this retirement because you want to diversify it, there's some other reason you want to pull it out, you will not be allowed to include any kind of distribution from an IRA where you've rolled it over to an IRA. You will not be able to include that distribution from an IRA, even if it came from WestPath originally. It will not be allowed to be offset by the actual cost of your housing allowance, your housing or fair rental. It will not be allowed. So this is another reason why you should seek tax advice to see if it's the right decision to roll these monies over to a IRA or not. And it might be you need to do it, but you need to be aware of the issues that might come up from rolling over your funds out of the WestPath to an IRA. The other thing you need to think about, many of you, this is a second career. You didn't start off as a minister, but you were called by God to be a minister later in your life. So you may have a retirement from another professional position or job that you are receiving. You cannot offset that other professional job or position unless you were a minister of the gospel. That cannot be offset by your housing allowance. Only the one from being a minister of the gospel. And maybe you have two. Maybe your profession was similar before and you were a minister of the gospel even in that position. But if it was totally different, you're not going to be able to offset that pension with the housing allowance. So you need to be aware of that also. The next item that I wanted to go over, and really the last one, is withholding versus estimated taxes. The nice thing about withholding, which you can have done at Social Security or even your pension, is that it's deducted all through the year. You can even make changes at year end. You decide you owe money. Maybe you don't have withholding during the year, but you decide you want to change it at the end. You could go ahead and send in the amount you needed so you will not have a penalty, and it's treated as if it was paid the whole year, even though you paid it at the end of the year. So for Social Security, you use a W-4V. For pensions, they have a W-4P, the 403Bs and the IRAs. So you could have these monies withheld. You've done a calculation. You know kind of what you're going to owe. You didn't do estimated tax payments. You can get in there and at the end of the year use the monies that are being drawn from your pension to pay for your estimated tax payments as withholding versus estimated tax payments. If you elect, you can pay estimated tax payments based on your prior year income and tax, with some modifications for future income in the next year, and you can spread it over 4 times a year. It's usually done due around April 15th, June 15th, September 15th, and January 15th. Sometimes there's a modification when the day falls on a Saturday or Sunday. It could be a 16th, 17th, and sometimes even possibly an 18th. And also along those lines, what about large withdrawals from pensions? Your example is you want to pay off your house. Well, if you decide to pay off your house and draw out the money out of your retirement, you're going to kind of have a double whammy. You're going to triple whammy. You're going to lose a big portion of your housing allowance. You're going to lose an itemized deduction. You may still be using the standard deduction, and you're probably going to have to pay tax on that large amount of the monies withdrawn. So this would be an opportunity for you to consider doing withholding in some form. You might want to remodel your house. You decide to take it from your pension. You may want to consider borrowing the money because that would be something that would still be deductible. Pay off debts. That's not going to. That's going to create totally a taxable event for you and really no benefits at all. So large withdrawals often result in taxes, and there again, that's where I would recommend you sit down with someone and project what it will be and what the tax will be so that you have drawn out enough money to cover the taxes and not hit with another whammy. Or is it better to wait to the next year to draw out the taxes because you'll be in a lower income bracket? And the last one I discussed before, the last thing I wanted to go over is moving expenses. It's just really no longer allowed, except for some people in the military, where before there were exclusions from income, and then there was also itemized deductions for moving expenses. So I've left with some resources that are on the web, but to be honest with you, you could pretty much type in anything in the search and probably find 1,000 different items on an area of a question. It's almost like an instant library for you. Feel free to call us at our office. I've given you the number, 863-904-2970. We have someone answering the phone even during this time, and they can direct you, or my extension is 7110, 7210, or 7310, or email me at phicks@fumf.org. I want to end with one thing, another thank you. Thank you, thank you, thank you for your years of service.